So, good afternoon, everyone. My name is Karmi Gutman. I am the financial planner over on the Retirement Management Office, which is just a partnership with Keystone Law Firm and Lifestyle Planning. Excited to have everyone on here today. We're going to be talking about what happens to taxes when one spouse is gone. It's one of those topics that can sometimes be a little misleading. You may have heard of terms such as the widow's tax that everyone is afraid of when something happens. And kind of the goal of today is, yes, that is obviously something one should be aware of. But what I'm hoping is that once we go through a case study today, it's not something that happens to everyone, but it is something that has to be planned for if it is something that occurs. Okay. So to very quickly just explain what the widow's tax is, it's not an actual tax that you pay in response to someone passing away. What it essentially is that, let's say if you were filing jointly, and then unfortunately one spouse passes away and you have the same amount of income, after they pass away, you are obviously not going to get the benefit of filing jointly anymore, which is where one could actually pay more in taxes. Okay. So the goal is, like, let's go through a case study together and see what the aspect would be before before someone passes away, and then what happens afterwards. And let's just go through it together. So we'll go through the case study together. But before I do that, I do need to make the lawyers happy. And essentially anything that we discuss today is purely educational. Nothing that I discuss here should be construed as investment, financial planning, tax, or any legal advice. Please make sure you consult with your trusted professional before talking or acting on anything that we discuss in this webinar today. Okay, so this is just purely educational. We're not going to be talking through any types of investments and such. But again, I just have to provide you those legal disclosures just to make the lawyers happy. Okay, now since we made the lawyers happy, let's dig into the case study. So we have Romeo and Juliet. I thought it would be really helpful if we go through a basic case study together. Romeo is age 74, Juliet is 73. They file jointly. They have an adjusted gross income of 150,000. We will talk through on the next slide what exactly constitute that 150,000 from an income perspective. But again, when we think about adjusted gross income, think of this as the total cash flow that you're bringing in. So that can be from rental income, that can be from Social Security, that can be from dividends, IRAs, pensions, annuities. All of that bundled together is what is going to be your adjusted gross income before any deductions and such. This isn't what is your taxable income, because that's determined after you make specific deductions or specific deductions to get your taxable income. So when you think adjusted gross income, we're talking about cash flow. A lot of people like to focus on this. This is because this is where most people's adjusted gross income is very similar to what would be reported to the Social Security for IRMA purposes. That's that fund tax you make if you make over 212,000 if you're jointly filing, or 106,000 if you're filing single. So we thought we'd just put that in there just for a base case. Both are taking Social Security. They both turned it on at 67 for their full retirement age, and collectively they collect the gross amount to 67,000. We collect gross. We said we wanted to specify gross because it's what is actually potentially taxable as a benefit. And then to make it simple, we assume they're just taking the standard deduction. Okay, so Romeo and Juliet, we got some details on them. Let's kind of see where is that what is comprising that $150,000 of cash flow. So they both obviously have some type of IRAs that they have to take out collectively 40,000 for the year. They have some interest income of $3,000 from money sitting in a savings account or a money market. And then they also have some taxable pensions collectively of 50,000. And lastly, the taxable Social Security amount as you may know, depending on how high your income is, the maximum amount of the tax you can pay on your Social Security is 85%, right? So no matter what, even if you are making a very large amount of income, the maximum that you would pay taxes of that is 85% of that. And in Romeo and Juliet's situation, it was around 80%. When you add it together, you get 150,000 of cash flow. So now that we got the basics with Romeo and Juliet, let's see how their taxes shake down in a 2025 tax year era. Okay, so let's go through the numbers. And I just want to make sure everyone can still hear me. You can give me a thumbs up. All right, I see some thumbs up. Awesome. Now, if we have any questions along the way, I'm going to take a quick pause. If you're on the video, you'll see an icon that has a hand. You can raise your hand. I'll pause. Feel free to do that in the middle of the presentation and such. If you want to ask questions, if you're not comfortable doing it during the presentation, you will see essentially a chat box on the right-hand side, right next to it looks like two people standing together. Feel free to click on that, and you can type your message, and I'll make sure to answer that at the end. Okay, so quick aside, getting back to it. So let's go and actually do the taxes, right? So we add up all of the sources of income. That's how we get to 150,000, right? As your adjusted gross income. Now we get to figure out what is exactly taxable, right? We made the assumption earlier that the standard deduction for 2025 was 31,500, right? So that would be reduced from the 150,000. Because they are both above the age of 65, they get the additional standard deduction collectively, which is 3,200. Divide that by 2, it's 1,750. But collectively, since they're filing jointly, it's 3,200. And then the new addition in response to the big, beautiful bill that was signed last year is that anyone above the age of 65 will get what is called a senior deduction. Up to 6,000 per person, assuming, this is the catch, you have to be less than $150,000 of adjusted gross income. If you are above 150,000, you will start getting in between the phase out range. So you are completely phased out of that senior deduction if you get to 250, if I remember correctly. Okay. So in short, because they are within that range, they get to take the full senior deduction. So when you take the 150 and subtract the deductions, right, we get a taxable income of $103,300, and this is the amount that will be applied to our specific progressive tax system. Okay, right? So if we remember, the first certain percentage is at 0, the next is at 10, the next is at 12, the next is 22. And when you add it all up together through the progressive tax system, Romeo and Juliet filing jointly will have a federal tax bill due of $12,554 and $1,434 for the state of Arizona. So essentially an effective tax rate of 12%. So for every dollar that Romeo and Juliet makes, based on the current situation, they're paying around 12% tax on it. Now, I went through this case first because it's important to establish a base of what the difference would be when actually one person passes away. So we went through the basic numbers of what their actual taxes would be filing jointly. Let's start talking about if Romeo passes away, right? Obviously, it's a very hard time for Juliet, right? But there is some specific assumptions that we feel is very realistic in trying to plan or to hopefully demonstrate why the widow's tax may or may not be applicable to every single person. Okay, so Romeo passes away. Because of Romeo's pension, there's a specific clause that Juliet will get 50% of that pension, which is pretty reasonable. Most pensions have a survivor clause for their spouse. The Juliet, because she is an eligible designated beneficiary according to the Secure Act, she is allowed to assume the monies of Romeo's IRA and merge it into hers and take it over her life expectancy. So it's not necessarily the 10-year rule. Again, this is something I looked up with the IRS because there is a fun diagram that you just have to double check every time. Because Romeo was 74 years old for our case study. But long story short, she's going to be able to assume those money into hers and unfortunately still have to take those monies out over her lifetime. She decided that because of Romeo passing away, she wanted to put some additional income into savings just to kind of help weather the storms. And lastly, because Romeo passed away, she's now going to lose half of Romeo's Social Security. For this example, we assume they were collecting the same amount. If Romeo's was higher, Social Security would bump hers to the higher amount. But for this situation, we're just assuming that they have the same, and she just loses that additional income. Okay. This is also assuming her spending doesn't change, right? These are all little attributes that will essentially change the situation, but this is one of those things though, like let's just get down to the numbers to see what exactly happens under what I believe is a more standard situation. Okay, so let's run through the numbers. So we know that she's going to have to now take essentially the same amount of IRA distributions from now since she took Romeo's IRA. So the same 40,000 has to be taken out. She put a little bit more money into a money market or a savings account, so she's getting a little bit more interest income. Because her Romeo passed away, right? She's only eligible to half of the pension and half of the Social Security. So on paper, she's losing essentially around $47,000 of income. Okay. Now on top of that, because now she's filing single, there is a lesser amount of deductions that you're going to be able to see in response to this change. So because Juliet is now filing single, unfortunately, she will only be able to take the standard deduction, which we are assuming she's going to continue to do, which is that $15,750. She still is eligible for that additional standard deduction for seniors, and I originally misspoke. It wasn't $1,750, it's $1,600 each, so a mistake on my part, but it is $1,600 a person, right? So if you're filing jointly, that's where the $3,200 comes in. And because now she now falls into the phase out range for the age 65 senior deduction, she doesn't get to take the full 6,000. So yes, there are some aspects to when one spouse falls away, and if you have too much income, you will lose out on certain specific deductions that will lower your taxable income, which we're going to see in a second, and then we'll compare it side by side. But I like to always just go through it step by step. So when we add up the cash flows and we add up the deductions, we see what's actually taxable for her is around $78,468. That's just the cash flow minus the deductions, and that's how you get the number. Then when you apply that 78,000 across the different progressive tax brackets, right? Certain percentage at 0, 10, 12, 22, etc. We get a very, very close federal income tax bill than to what we just paid earlier, right? Around $12,000 in federal and $1,300 for state. But there is a big difference. As you can see, technically, for every dollar that Juliet will make going forward, she's going to be paying around 15.5% tax on it. So yes, when we look at it, there will be higher taxes on paper. There's going to be a higher percentage of tax that Juliet will pay. But when we all get down to it, the balances due are roughly in line to what they were doing when they were filing jointly. Now, I understand this is essentially we are assuming that the expenses haven't changed or they haven't increased, or there was not the same amount of income when they passed away. But most of the time, at a minimum, right, if they're both collecting Social Security, most likely that one aspect of that will go away, right? So we just wanted to kind of give like a more simple example of what happens. So side by side, you can see filing jointly, what was the tax balance due? $12,554, $12,000 for filing single, around $1,400 for Arizona, and $1,300 for state. But like I mentioned previously, yes, there is a higher percentage amount of tax for every dollar Juliet will be paying filing single relative to filing jointly. And that's really in response to her deductions essentially being cut in half, right? Because while filing jointly, you get a higher standard deduction. She was also within the eligible ranges to get the full senior, what I call the senior discount. That's the $6,000 a person, right? So filing single, she has unfortunately put herself into, she's unfortunately been in a situation where she doesn't get the maximum amount of deductions, right? But when you look at it apples to apples, for the most part, at least in this situation, the amount of tax really isn't going to change, mainly because of the fact that her expenses hasn't changed relative to what's being brought in. So the widow's tax is not always as scary as one would want you to believe. Okay, it just takes down into planning it out and running through the numbers through tax software, through your trusted professional, to just kind of run through the numbers. But utilizing this same point, right? If the income were to stay the same, then it's a no-brainer. She would be paying a lot more in taxes relative to if she was filing jointly because of the loss of the deductions and such. So, and I'm going to quickly summarize, and then I'll also bring in the tax planning software that we use, because sometimes it's helpful to just bring in situations just to kind of see like what would happen if pension went up. And sometimes people are visual and want to see it live. So I'll bring that up once we get through the summary, because I know there can be some very nuanced caveats that some would like to ask that weren't in the base case scenario. But like I was mentioning earlier, the widow's tax is not the same for everyone, and it won't essentially be applicable to everyone. It really just depends on what are the sources of income that the people that are, you know, looking to plan for have, and how do they adjust, or how are they taken into consideration when one spouse passes away. If anything, I would be more inclined for those that are worried about the widow's tax is to really focus on income planning in this response to a loss of income in response to one spouse passing away, and then obviously the emotional aspect of a new reality of losing a spouse. So I'm going to pause here for some quick questions before I bring on the tax software. With that in mind, what questions do we have at this moment? If you have a question, a quick reminder, you can actually type it into the chat box on the right-hand side. You'll see it right next to the icon where there's a red leave call button. You hover over to the right, you will see two people kind of standing next to each other. Right next to it is a little chat icon. You can essentially just type your question in there, hit enter, and then we can review the questions if you're not comfortable just speaking off the mic. But like I said, I'm happy to kind of go through and adjust certain numbers so you can see what the difference would be on the tax software, because this can be a very, very nuanced situation. But we really just wanted to get across that it's not essentially the boogeyman that everyone wants you to think that it is. It just really depends on each person's individual situation. Okay. So if we don't have any questions, I'll just bring up the software so that we can kind of just see the different examples. So we compare it apples to apples, just so you can see, because I always think that's helpful. Let me share my screen. Okay. Let me know if you can see this with a thumbs up. All right, I see a thumbs up. Awesome. Perfect. So on the left-hand side, this is our base case. And on the right-hand side is going to be Romeo passes. So we went through the different examples of the income that was come in. I did a little bit of rounding. But when we get down to it, right, there's the essential, what are they paying in federal, what are they paying in tax after Romeo passes, and after the different adjustments. So let's say, you know what, Karmi, I think you're kind of making an assumption that income would be this, would decrease. But what if the pension was full that Juliet gets? What happens, right? So if we adjust, so instead of it being, let's assume that it's going to be a full amount that gets passed on to Juliet, what would Juliet's tax be? So when we add it up together, right, let's not make any other changes besides just the pension. What would happen to, well, we have to make the adjustment for Social Security, because that you can't get both, unfortunately. Uncle Sam will not allow you to do that. But if we just made the adjustment of Juliet keeping the same amount of pension, which would essentially bring her income from that 100,000 to 120,000, her actual taxable bill on federal and tax is going to start to get pretty noticeable, right? We were paying essentially 12,500 filing jointly, but because the income is essentially, aspects of our income are staying the same and we don't have those same deductions we had previously, on paper, we are going to end up paying more taxes, right? So in this situation, we're talking about her federal going from 12,000 to 17,000 and her state going from 1,400 to 1,800, right? So on paper, her effective tax that she's paying for every type of dollar made is essentially 17%, right? So this is kind of why I really like to stress that the important aspect to really take into consideration when trying to plan for taxes when one spouse passes away is really going to be attributed to the type of income being brought in, right? Because if this was all income that would essentially stay the same when one spouse passes away, then yes, that spouse will be paying more in taxes and will require some tax planning or income planning, etc. But if there's going to be income that will be going away or being reduced when one spouse passes away, it's not necessarily the case that they'll be paying more in tax, kind of like what we just showed in that previous example. Since we kind of went through one with the pension staying the same, is there anything else that someone would like to see? I'll give a minute or two for people to think. I either did a really good job or I went way too fast. Probably a combination of both. I know it was a lot, but I do want to make sure if there's questions that come up, please don't hesitate to ask. You can chat here on the actual video. You can definitely give us a ring. It just takes some time to digest. It's not a fun topic to think about, but it is something that we felt from the Keystone side and the lifestyle planning side to at least kind of bring it to everyone's attention. Yeah. Michelle, what question can I answer for you?
Hey, Karmi, I'm not sure if you can see in the chat. I asked if there's a chance that the IRA distributions would increase as a result of the rollover to the surviving spouse. Is there a possibility that the surviving spouse would have to take more money out of the IRA based off of the increase in IRA money that's in the account?
Great question. So it will all depend on what amount is being transferred over. For the example that we did in the case study, I made the assumption that the IRA amount would be roughly the same that was being rolled over. But yes, the RMD could be higher, right? Because it all depends on when the money is rolled over relative to what the balance is December 31st of the following year. So if the market does well, it could be higher, right? Because you have a higher numerator being divided by by either a lower denominator number, which is going to be the life expectancy factor based on a uniform life table. So yes, it can be higher, but it can also be lower depending on how the market does, right? Because if they roll the assets mid-year, it's not that you won't experience that higher or lower RMD amount until the following tax year when it's based off of the December 31st balance of the prior year. But a really good question, but it can be higher or lower depending on how the market does, depending how it's invested, and etc. Now, another point also to take into consideration, a much younger spouse may have a lower RMD amount because the life expectancy table that they would be able to start taking distributions from that over their life could be much longer than an older spouse. So it really just depends. But a really, really good question.
And if anybody has any other questions, we'll wait on that, Karmi. Just want to plug the next couple of webinars we have coming up in the meantime. So we have the Intro to Wills and Trust hosted by Francisco. This one's going to be on the 27th of February. So it's going to be this Friday. That one's going to be at noon. I'm going to drop that here in the chat. And then the next one is by Michelle Dexter, which is Inheritance Protection, Stop Funding the Addiction, Spendthrift Trust. Basically hosted by Michelle on the 11th of March at noon as well. So I'll drop both the registration links here for you guys to join if you guys want to. And go from there. Back to you, Karmi.
Awesome. So obviously everything we kind of discussed today is going to be very dependent on each person's individual situation. So if this is something that you would like for someone to look into for you, or just to get an opinion or a second set of eyes on it, you can definitely give us a ring, either the Keystone line, if that's what you're more comfortable with, on the lifestyle planning line, which is listed there, or just feel free to shoot me an email if it's a specific question. I'm happy to answer as many as I can. However, just to be fully transparent, any specific type of question that's going to be very nuanced will require some tax information, some income, and if those are things that you're not willing to share, I can't really give any good guidance. Okay, so because of the nuance of this, it just has to be done with as much information as possible, because as you can see, if there's a wrong input in there, it could change what your tax situation could be. Okay. So overall, I hope everyone enjoyed the presentation. I know it was a little fast and there was a lot that we went through. This is being recorded. This is also going to be put on the Retirement Management Office YouTube page. So you will see that being uploaded later. So definitely feel free to take a gander of that once it's uploaded after it goes through our compliance checks. But I hope you were able to get something from this. I hope you realize that the widow's tax is not always the boogeyman that you need to fear. It just really comes down to each person's individual situation. Okay. So thank you so much for the time. And like I said, if there's any questions that come up, don't hesitate to give us a shout via phone or email. But I really appreciate you guys joining the call today.